Hello, clients and friends of MBP Sterling Partners. It's Jamie here. I'm back with the Q1 2024 recap and outlook. So let's jump into it. Firstly, looking back at the returns from this quarter, we won't spend too much time on this. Safe to say that equities rallied and every sector participated except for those rate-sensitive sectors like utilities and real estate. Rates did climb back up a little bit, so while the Treasury and Canada markets remain positive from the coupons, their values actually declined a little bit with rates rising, and that's what led to the weakness in those sectors. More importantly, we're looking back at what happens in these rallies after we've recovered from a bear market. Historically, looking back at those bear markets, which we had in 2022, and after we've recovered to a new all-time high following those bear markets, we like to see what the market did following those rallies. And almost unanimously, we've seen the rally continue. 1, 3, 5, and 10-year outlooks beyond those new highs have almost always been positive, which leads us to believe that it pays to buy new highs. Now, this might be different, and there were a couple of instances, particularly the 2000 scenario, which was a long, protracted bear market where we did not see those positive returns come after. But for the most part, we see returns continue to move higher. And so this gives us some historical confidence that the rally will continue on despite some valuation concerns that we'll get into later. This rally has felt short and fast, but looking historically, these bars represent the number of months consecutively that the indexes have risen, the S&P 500 and the TSX Composite. And you can see that the current rally at 5 months is not so far out of the ordinary. Looking back to 2010, this has happened several times, and the scope of the rally hasn't been extraordinary either. At 4% per month, we can see that's just a little above what the average has been. The average has normally run around 3%, but there's been a few outliers that have been considerably higher than this. So this has neither been a very long rally nor a very sharp rally in historical context, even though it feels that way. Looking at the concentration of the index, this has been a theme of ours for quite some time, with the Magnificent Seven taking over such a huge concentration. That concentration remains when we look at the capitalization. So 32% of the S&P 500 is now amongst these big names when we include the other heavyweights, Eli Lilly and Berkshire. Lilly certainly has done it in terms of the returns that it's provided. They are very Magnificent Seven-like. But the rest of the market has caught up as far as the returns concentration goes for this quarter. Even though the cap concentration is still there, the returns have been much more broad-based. You can see 393 of the S&P 500 companies are up this year to the quarter. And in fact, 2 of the Mag 7, Apple and Tesla, have negatively contributed to Q4 returns for the S&P 500. And so what that has come out to is cap-weighted or equal-weighted indexes have normalized again. We didn't see this phenomenon in Canada, so we're running along where the cap and the equal weights continue to be about equal. But in the US, we've seen that cap-weighted index really curtailed versus the equal weight, which is coming up from behind. In the bond markets, we have seen yields grind a little bit higher this year. We mentioned this earlier after declining a lot in 2023. Now, they've been range bound. That's what we'll call them. Inflation has proved kind of resilient, and it's not dropping as fast as those central bankers would like. And more importantly, employment has continued to be very strong. We had really good employment numbers recently. And that hasn't given the central banks a lot of reason to cut rates. Now, we hope that they're forward looking and they see things that we don't on the indicators, but for the time being, this has led to the price cut expectations from the central banks to be pared severely back. When we look way back in history at US 10-year Treasury yields, this chart in the bottom goes all the way back to the 1960s. We start to think that maybe it was the high rates of the 80s and the very low rates of the 2010s that were the anomaly, and the middle of the road 5-6% range is actually more normal. So what we've seen so far for the past year after this rate hiking cycle is that the economy can withstand it so far. So maybe we operate just fine in this 5% range, and we shouldn't be expecting some severe rate cuts back to those lows of the 2010s. Yield curves are still inverted. We're now at a new record for how long the US yield curve has been inverted. And while it generally has preceded a recession, This time could be different, or this time could set a new record in terms of the amount of time that the yield curve is a leading indicator. A normal yield curve is positively sloped, meaning 50 to 100 basis points between the 2-year and the 10-year yield. We're now at about negative 35. So we need to see about 200 basis points of normalization in the curve. Now, how could that happen? Well, we could get short-term rates decline, or we could have long-term rates rise in order to make up those 200. We tend to think it'll be a bit of both. But if we get back to a normal yield curve environment, there will be some pretty big moves on the 2 and the 10-year rates, respectively. In terms of where we are historically, this bar chart on the lower right shows that this inverted curve happens relatively infrequently. The most normal, as we mentioned, is between 50 and 100 basis points positively sloped. So rate expectations have been paired considerably. These line charts at the top show where the market was thinking the Bank of Canada and the Fed were going to be. So come the end of the year, the September outlook was for a 4% overnight rate. That's been taken back up to 4.5, 4.75. So only a couple of cuts between now and then. We'd like to point out that this is just the market pricing in these things. These are not predictions. But the red and blue bars on the right show those expectations for Canada and the U.S. at each central bank meeting going forward. So market thinks that rates aren't going to be cut as much as the market thought this time last quarter. Why is that? Well, we've seen some real strength in the economy. These are Canadian GDP numbers we're looking at the bottom. The horizontal bars point to January's GDP report, where you can see almost all sectors were positive. And the vertical bars show Scotiabank's expectations of what Q1 2024 GDP will look like, which is very positive. This is not a rate cutting environment in terms of the economic indicators that we've been getting. Valuations look relatively expensive versus history, with the exception of the bond market. So our proxy yield for the bonds still looks quite cheap. We're getting in that 4 to 5% range on bonds, whereas historically, this history obviously takes into account a very low rate environment. So we'll keep that in mind, where it was a mid 2% average yield and we're into the fours, which is why bonds look relatively attractive. On equities, we use price earnings ratios, and the US looks a little bit expensive versus its historical norm, whereas Canada looks a little bit cheap. Importantly, since the start of 2024 and certainly the start of 2023, we've noticed that these multiples have expanded considerably. This rally has been based on multiple expansion. The bottom left chart shows us that earnings expectations for 2024 and 2025, those are the gray and purple lines, have not risen substantially, but the market has priced in earnings to rise. Now, sometimes this will right itself with the earnings eventually coming around to meet the higher expectations, and other times multiples will contract and the stocks will drop in order to meet those lower expectations. We're not sure which one this will be, probably a bit of both, but we would point out that historically, again, going back to the rally continuing following bear markets, historically, it's been the earnings that have come up to meet those multiples and bring them back into check. The outlook on rates we talked about a little bit earlier, but we'd like to look at rate cut cycles here a little bit and notice that in the past, rate cut cycles have tended to be hard and fast. The scenario of having just a couple of cuts into a Goldilocks economy really doesn't happen all that often. We do note that in the mid 90s, that's the type of environment we saw. But all the other cutting cycles, 2000, 2008, 2020, 1991, 92, those cutting cycles have all been hard and fast, and the central banks were cutting in a hurry, usually in response to some sort of event. And you go back to any of those years that I mentioned, I'm sure you can think of an event that happened economically that caused the central banks to want to cut in a hurry. As we mentioned on the economy, the indicators have started to look a lot better. Our cycle indicators have been trending positive. They continue to through Q1 2024. The recession probability has receded, and we will note that some of the economic indicators like copper, crude oil have started to rise, and the rest of the commodities complex, we include gold in this, has been strong. Now, these are generally indicators of a strong economic environment. So despite many people's belief that high rates were going to crush the global economy, it is proving resilient, and most of those calls for recession are just getting pushed further out. Why? Well, it's hard to have big recessions when the governments are spending so much money. These are budget deficits. We showed this chart last time. They have been absolutely huge, both in Canada and the US. We don't expect this to change in election years, US election year this year, Canada's election year next year. The governments love to spend going into an election to secure themselves a job for the next 4 years. So we expect that government spending will continue, and it's hard to have a recession in the face of this much spending. On the Canadian dollar, we have a slightly negative view on the loonie. The reason for that is Canada is more indebted at the household level than the US is. You can see our line chart here where the US household debt as a percent of GDP has been declining since the great financial crisis in '08. So the US had their debt reset moment back in '08, '09, whereas Canada has not. Ours has continued to rise. And so that means that the latest rate hike cycle will have an outsized effect on Canada relative to the US. This is negative for the loonie because it means that our rates will stay lower. And the interest rate differential between the US and Canada goes a long way to predicting where the loonie is going to go. The lower the Canadian yields versus the US, the lower the loonie has tended to go. Now, where we could be wrong here is in energy prices. Canada also has a strong tendency to rise and fall in its currency alongside the price of energy, and we have seen crude perking up. So strong oil, strong natural gas prices could lead to a stronger Canadian dollar. But our outlook here is based on the interest rate differential, which we continue to think will be negative. I'd like to leave with a final thought about the Magnificent Seven and the huge run up that those stocks have had. Courtesy of Dimensional Fund Advisors, we found this interesting statistic that shows the rate of returns for companies as they enter the top 10, at being the top 10 in the S&P 500 by weight, and before and after they join that top 10 status. So obviously, before they join, they're going to show some great returns. That's how they got to be to the top 10. But what we found really surprising was afterwards. After they've hit the top 10, on average, over the past many years, they've averaged out to no return 3, 5, and 10 years after. We found that really fascinating. You know, this is not just below market return, this is zero return. And so while we focus a lot on these big companies and how phenomenal their performance has been, history would suggest, and of course there are some outliers like Microsoft, which joined this club in 2000 and has had phenomenal returns since then. There are outliers. There are also lots that join the top 10 and then decline substantially to not be there anymore. So on average, it hasn't been a good place to invest. So we prefer to focus down the chain a little bit where there's a little bit better value and pick our companies where there's still a lot more room to grow. So as always, our advice for an unknowable future, we invest for the long term. We want to invest in quality companies and securities, and we want to be diversified amongst asset classes, sectors, and companies just to make sure our returns are consistent. Thanks everybody for joining us. I look forward to talking to you next time. If we can be of any service, please give us a ring. Have a great day, everybody.